All right. So excited to kick off another one of our investor podcasts today. Have someone that I really respect. I've got Scott Sherman, who is the managing partner at Mesa Lane Capital Partners. I'm just going to give a quick high-level overview, and then we're going to go a little deeper. But Mesa Lane Capital is an alternative investment firm that delivers multiple different revenue streams to investors by seeding and investing in the next generation of emerging venture capital GPs. Scott has over 19 years of seeding and structuring experience at industry leaders like Blackstone and Tiger Global. He seeded over 25 plus managers across various assets. Previously, he was a general counsel, chief compliance officer, and member of management committee at Tiger Management LLC. Also, he was a managing director at Blackstone Alternative Asset Management, co-led the launch and operations of TigerGene Venture Studio and 3 portfolio companies. So excited to go deeper on that. The way that we're heading with a lot of these bigger franchises, kind of having a roll-up strategy. And then, he also serves as a board member to multiple portfolio companies. So I had the honor of spending some time with Scott a couple of weeks ago in person. We got a bunch of fund managers from our Sutton Capital program and many of the institutional LPs that are our peers there. So good time, got to really catch up with a bunch of old friends and meet some new friends. But Scott, welcome to the show.
Thank you so much. And thank you for having me. And as I said to you directly earlier, thank you for everything you do, not only for the emerging manager ecosystem, which is so critical and needed, but just the community building that you do. It's so impressive. And I personally appreciate it. And I know a ton of others in the ecosystem do as well. So thank you.
No, thank you so much. It's my pleasure. And look, at the end of the day, it's a lot of fun. If you can do what you enjoy doing, and there's always so many changes in the market, it's so stimulating because you just learn so much, and I think, really kind of double clicking on the platform that you built. I think there's a lot of knowledge transfer because a lot of people don't know about this platform and opportunity as an alternative to kind of building their firm. So excited to double click on many topics, but I think one of the first things that's important, and it cascades across one segment of our community, which is kind of aspiring people that are looking to just get into the industry, get a job or pivot their career. And I was one of those people myself, becoming like an engineer's engineer, and then, being self-conscious about being technical and kind of moving into the investment space. So, and you've worked, you're kind of like someone that's worked at the top tier institutions that people dream of working at, so I think it'd be good to kind of learn a little more about just your origin story. Where did you grow up? Who are your influences kind of thinking about where your career would head? Maybe what your parents, were doing for their careers. And, would love to kind of talk through, high school, college, and kind of how that, got you to where, maybe talk about how that got you to Blackstone and Tiger and now at Mesa Lane. So a lot to cover, but, within the time that we have, we'll try to cover what we can.
Sure. That's going back a long way, and I'll try to be brief, but, it's really funny. I originally wanted to be a sports agent, and I grew up in New Jersey. I worked for the New Jersey Sports and Exposition Authority one summer, and then for an agency another summer right before I went to graduate school. And very quickly realized that 10%, and there are exceptions, and I don't, people love that industry, and God bless them. But when a client called us from Hawaii to say, could you call the front desk of the hotel I'm staying at to tell them X, Y, and Z, rather than just picking up the phone and calling the front desk, I said, I can't see myself being a babysitter for the next 30 years. Like, I want to do something meaningful and impactful, and service has always been a big part of who I am. I led a community service organization, both in high school as well as I went to college in North Carolina at Duke and led a 120-person community service organization. We had 13 weekly community service activities, providing services to 11 different organizations weekly, from 120 people in our club. And part of that was community building, as we just alluded to earlier, something that you're doing and that we're trying to do at Mesa. within the emerging manager ecosystem. And so that has always been a part of the fabric of who I am. Number one, giving back, but number two, community building. And so ended up going to grad school at Columbia, did my JD MBA there, and started my career doing M&A and securities work at Wilkie Farr. But after 6 months, gravitated towards the investment management practice and started working on, and this is going back to like 98, 99, 2000, as the investment management industry was really growing up. So started out on hedge funds and was, had a very fortuitous opportunity that a former colleague that I had worked with when I was a summer associate was at Blackstone, and they were building out their alternatives group, and they were looking to hire someone on the due diligence and investment structuring team. And I was fortunate enough to be given that opportunity early in my career. And so joined Blackstone in 2003 and ended up there till 2016 when I joined Julian Robertson's firm, Tiger, and helped. While at Blackstone, we grew from 8 billion to 80 billion, and we launched multiple platforms. We launched a mutual fund platform, a seeding platform, a co-investment platform. We were really pioneers, I think, in the asset management space, and obviously Blackstone still is today, and have the utmost respect for that organization. I have a lot of friends that are still there. But when I had the opportunity to join Julian as a member of his management committee, the opportunity to invest across asset classes was incredibly attractive. And I ended up spending 7.5 years at Tiger until about 6 months following Julian's passing. But when I, at the peak of my time at Tiger, we had direct investments in 40 plus operating companies. We were invested in 19 venture firms, 5 of which we had seeded, 24 private equity firms, 4 of which we had seeded, obviously a number of hedge funds. That was Julian's legacy. And where
that was the Tiger Club, that was the Tiger Cub program, I believe.
The Tiger Cubs and Seeds. That's exactly right.
Many of them have gone on to be massive institutions as well.
Multi-billion-dollar enterprises. And really, from my time at Blackstone, where I worked with over 400 managers on our platform and built a manager community. And then what I did at Blackstone was I reached out to others in the investment management space and started almost like a networking opportunity whereby investors, COOs, CFOs, attorneys, portfolio managers, and the group grew from about 10, 15 people to about 120 to the point where we needed bigger meeting spaces and we needed sponsors. And we were all able to share non-proprietary ideas and things that if people had been going out on their own would have cost them a lot of money to go to their attorneys or someone else to get the advice. We were able to build a community and provide that advice in real time from people who had actually lived it. And we did that as well at Tiger through the Tiger community. And I found that to be incredibly valuable because one of the things that most often derails emerging managers is that they get pulled in 20 different directions. They're spending 50% of their time fundraising, 20% of their time building a business, hiring service providers, vendors, operations, HR. And what does that leave them? It leaves them 25 or 30% of their time to focus on what they actually, their superpower.
You're supposed to be deploying capital,
Right. Being a fiduciary, sourcing deals, investing capital, that's what they're great at. And at Mesa and at Tiger and at Blackstone, what we wanted to flip that script and have them spend 70 to 80% of their time doing what they do best, because we think that accelerates their ability to produce top quartile results. So if we can help them with those ancillary things in terms of running a business, building a business, scaling in an institutional manner to become attractive to institutional investors, and go through an institutional due diligence process, that's where we've really tried to forget the capital. We are providing a large anchor check, but beyond the capital, we want, like they are helping their founders, we want to help them.
No, I agree. And I think, we see a lot of that activity within our platform. Like there's a lot of chatter. We have like, Slack channels and some WhatsApp groups, and, a lot of the alumni that come out of our program, they already share, pros and cons of like, a certain fund admin that they recommend, or a back office provider. And then what's great is, you've seen this, a lot of those fund admins, they kind of, a lot of the service providers, they lean into the community too. They do experiential stuff to kind of build those bonds together, but that cuts out some of the time, because the time that you'd be spending, you're probably going to spend at least 5 to 10 hours diligencing the right vendor that accommodates your budget. And then obviously you don't want to sacrifice on quality when it comes to some of those back office functions. But to your point, having that tribe of other people, that just helps to kind of shorten some of your diligence process. And then you probably have recommended vendors that you just trust and know, and those contact points are there, versus you trying to cold email those websites and then wait 2 days for those people to get back to you, right? So
yeah, and I think it's also each of these shops, whether it's law firms, fund administrators, audit and tax firms, outsourced CFO, fractional CFO firms, PEOs, what have you, it's so often dependent on the team that you work with. The organization, one group may have had a terrible experience with that group, and another may have a phenomenal experience because of the team that's assigned to them. So to your point, having that direct insight into, okay, who at these firms have you worked with, and why has your experience been the way it is, I think provides even more value.
Some of those people have gone to the lengths of just putting together a rubric. Like they put together a spreadsheet already, and they already have like a pros and cons list. So some of that diligence, why not recycle that and reuse it if someone's already done it? So it's all about like, leveraging smarter people that have already done the work, and then obviously measure twice and cut once, right? So yeah, no, I totally agree. And I love that kind of has cascaded to what you're building at Mesa Lane right now. The next point that we're going to talk about is, you were an attorney in the beginning, you kind of had that background. So there's superpowers that attorneys possess, obviously, so many different things, negotiation skills, confidence, understanding what the contracts mean. But, your past life kind of wanting to also be a sports agent. I think of that show. What was the show with the Rock? He was like a sports agent. I forget, it was on HBO, but I liked how that cascaded into asset management, right? I mean, a lot of your clients are high net worth clients. Traditionally people that, come out of football, they last like 4 to 5 years, and I went to a really cool private equity sports event in LA, and there was a bunch of athletes there. And I think it's really cool that, having these firms like Next Legacy, right, that are kind of thinking about the next play, the next legacy. So trying to use your superpowers and really figure out how that has a niche in the market, right? That relationship with the sports community, maybe that's the first community that you start out with to kind of think about your first checks as seed investors into the fund. If you come from like I've seen some people that come from like the cybersecurity space, right? They've already built that community. So that's what they're going to, have tunnel vision on and really have conviction on in terms of their fund size and their strategy. So we'll love kind of your reaction to that in terms of kind of leaning in, and just maybe some of the things that you learned. I believe you were like a general counsel for one of these firms too, right? So kind of those legal, skill sets and superpowers, and how that kind of translates into how you're looking at managers too. Like you've talked to me about some of the managers that you've seeded, and I've learned about their background, their past life, and there is some correlation with kind of some of that stuff kind of relaying over to your next step in your life.
Yeah, well, a couple of things, and it's a great question, and thank you. Julian and Alex used to say that there were several backgrounds in investors and business people who are running businesses that are very attractive. And to your point, former athletes, Division I, or even collegiate athletes at any level, professional athletes, and military personnel. People who have a discipline, people who are able to be rational when others are acting irrationally. And it could be other skill sets as well. And there are a number of them out there. But again, it's about people who are able to be calm under pressure, act rationally when others are not, and see the forest through the trees. And bringing this back to your original question, as an attorney, one of the things in your training is the ability to understand both sides. One of the exercises that you do in law school is you have to argue both sides of a case. And so it teaches you early on to see multiple perspectives. And I think in anything that you do, forget investing, anything you do in life, perspective taking and listening is critical. Being able to hear people, listen more than you talk, because the more you can take in and understand and hear diverse perspectives, the better counsel you're able to provide, whether it's legal advice, whether it's strategic business advice. Having the context and the perspective informs how you will approach that situation. So yes, being able to negotiate and being able to read contracts and things of that nature, but more than anything, being able to see both sides and understand both perspectives coming into a transaction, I think is one of the most critical skill sets that legal training provides and that anyone can have in almost any industry.
And then I think the final piece to kind of translate to invest, and once you understand both of those sides, I guess making sure both of the incentives are aligned, right? And it's a win-win for both sides. So kind of really taking it to the finish line there. And then, I've heard a lot of institutional LPs, especially larger families, they like really the concentrated approach. So they like specialists. So I wanted to hear your reaction to that, in terms of just, when you look at managers, is it better to kind of focus on an emerging manager that, has come from, the space industry, right? And now they're kind of going all in, kind of launching a firm that's focused on space. It could be different pieces of the market as well. Like, many of these firms, some of the ones that I've seen that have done really well, they're going out to market with like 3 funds at the same time, right? They've got an early stage strategy, they've got a late stage strategy, and then, they have a SPAC strategy as well. But, going back to the basics, what's your reaction to, I guess, my comment in terms of like having a sector, focus as a specialist versus obviously being a generalist?
Sure. Well, first, I would say that as an emerging manager, do you have the infrastructure to support multiple funds and multiple platforms? I think the infrastructure and the personnel with expertise, and because investing in early stage, growth stage, private equity, what have you, they are very different skill sets. There's very different due diligence that's performed at each stage of evaluation of an emerging company. And a company that may be later in their life cycle. So do you have the experience and the expertise in each of those areas in place in order to be even able to do that? But to your specific question, we are both strategy and geography agnostic. We do have a 25% concentration limit in any one industry vertical in our fund. But what is most critical to us, and that success and we focus solely on early stage venture. It's not to say that our GPs won't do follow-ons and things at a later stage, but primarily we focus on emerging managers in early stage, which we define as pre-seed, seed, Series A, and maybe a little Series B, primarily. Success historically has come from either an investing background, a founder background, an operator background, a number of other backgrounds. But what we like to see, we tend to prefer co-GP teams over solo GPs. It's not to say that a solo GP couldn't get through our process. We, again, from a differing perspectives and 1 + 1 = 3 standpoint, we tend to prefer co-GPs with complementary skill sets from the areas that I just alluded to. Sure. Because if you compare an investor with a former founder or operator and bring those skills together in a cohesive way, we believe the value that they'll be able to add to their founders is exponentially increased. What we are really looking for, though, is, and people throw around the term edge, so I want to be very careful. There are a lot of GPs that tout a track record and they were invested in this unicorn or that unicorn. I don't care. What I want to know is, number one, at what stage did you invest? But more importantly, what value did you add to that founder and that company? What role did you play in their success that makes your edge that makes your expertise, that makes your fund management skills sustainable and repeatable. Because we are investing in firms, not just funds. So we want GP teams that are going to delivering 3, 4, 5x returns, delivering top quartile returns. That's the table stakes. Are you going to be able to repeat that? Are you thinking about business building the right way? Are you able to consistently deliver value to the founders that you're backing? And if I called all of the founders that you backed in a previous life or in your current fund, are they going to tell me that you're one of their first phone calls when something goes sideways or something goes wrong or where they need advice? Because you are either helping them on go-to-market, commercial application, maybe you're helping them think about valuation and the next fundraising round and who should be in and how they should think about valuation. Maybe you're thinking about, product efficacy or how to position themselves from a brand standpoint at the portfolio company level. There are any number of ways that you can be adding value to your founders and your portfolio companies, but is the manner in which you're doing that and the lens that you're approaching it from sustainable and repeatable? That's what's most important to us.
Yeah, no, I totally agree. I think having a firm versus a fund is super important. And, that's what's going to really take you to the second fund and the third fund as well. So switching gears, this is more of a career development question. So, as I mentioned earlier, you've been at some of the most world-renowned firms, and these are firms that people, aspire to land a role at coming out of college. So, what career advice would you give to people, maybe coming out of college, maybe even mid-career professionals that are looking to pivot? And, some people that are pivoting, kind of like myself and, some of the people in our platform, how can those young professionals build their network if they don't have one? You kind of organically built that, in your current firm and in your past firms. And maybe some of those superpowers come from being in the sports industry as well, kind of that camaraderie that comes with it. But yeah, on those two things, maybe just general career advice in terms of the skills that you need to kind of really outperform at a top tier firm when it's very competitive. And then, how do they get in those rooms? How do they connect with those people and kind of get those people in their network?
Yeah, be persistent, be proactive, go to industry events, study, do your homework, do your research, learn who the key players are, learn what firms you'd even be interested in. Not all firms are created equal. Some of the large banks are very different from some of the other. Some of the, obviously emerging managers, the space we play in, it could be 2, 3 individuals. They may have venture partners or advisors or others, but these are very small firms. Learn the type of firm you think you will thrive at and seek out opportunities. Get your foot in the door at a young age. At a very young age. Get your foot in the door any way you can. And then once you're in the door, be the first one in, be the last one out. Establish a reputation for yourself built on going the extra mile. Earn people's respect. Don't expect people's respect, rather. Earn their respect every minute of every day. Go the extra mile. Don't be a jerk. Be helpful to others. I always believe in paying it forward. I still do interviews, for Duke. I was on the HR committee at Blackstone, was very active in terms of interviewing within our group at BAM. I, like I said, started a networking group within our industry. I always went the extra mile to reach out to the GPs that we had seeded both at Blackstone and at Tiger to develop relationships, because I find that once you earn people's trust, you're going to be their first phone call. And so if you can develop that type of relationship where people come to value your advice, again, goes back to what I said earlier about being a listener rather than a talker. Don't just talk to hear yourself heard. Listen to what others are saying so you can actually give them what they need, not what you think they need. These are all skills that, quite frankly, take time to develop and you can only get through experience, but that I think are probably the most valuable. Prove yourself every day and don't expect anything to be handed to you. Earn it.
Yeah, no, that's good advice. Um, I want to double click maybe one level deeper in terms of maybe the hard skills and the soft skills. And to add to that question, I want to play off of something that you mentioned earlier, which is the approach, the diligence approach, the strategy, and how you handle deployment of capital is going to be different depending on the strategy, right? Whether it's early stage, late stage, growth equity buyout. So maybe, it'd be helpful for the audience for you to talk through maybe three different types of strategy. It could be early stage, that compared to obviously the diligence of late stage. There's revenue, there's hopefully coming into profit, EBITDA at some point, as they're thinking about an IPO. But maybe if you could walk through maybe the technical skills, soft skills that are needed, and maybe just cover that across maybe two or three strategies, right? Early stage versus late stage, and maybe tie in a few stories that you're allowed to share to support that if possible.
Sure. I mean, we again at Mesa, we're focused solely on early stage, but having previously looked across asset classes and stages of company growth, happy to focus a little bit on that as well. I think at the early stage, again, first and foremost, what makes these GPs qualified to be able, like we're attempting to identify qualified GPs, we expect them, and what makes them adept at repeatedly being able to identify qualified founders. What about their background and experience enables them to successfully evaluate founders in a way where they will increase? Obviously, everybody talks about the power law, but the more winners you have, the better your performance is going to be. And so if your hit rate increases because you are particularly adept at, and there could be a lot of reasons companies fail, particularly at the early stage and beyond, but what makes you adept at identifying founders that are particularly qualified not only to build businesses? Obviously, you have to believe in the idea, the innovation, the technology, what the problem they're solving. And then being able to identify those founders' strengths and weaknesses and being able to offer complementary skills. What are you and your venture partners, your advisors, what are you and your team bringing to the table that maybe these founders don't possess, where, again, you're putting your finger on the scale to accelerate their chances of success? Because we all know that at the early stage, it's the Wild West in terms of building a company. A lot of these companies, especially the hyper growth companies, are hiring people that at the same time they're trying to develop commercial application, they're trying to build a culture. And those are two very different skill sets, right? Being a manager on both sides at the founder level, you have to manage the organization from a culture perspective and build a brand, bring your product or service to a consumer, and build your name in the marketplace. And at the same time, you're doing both of those things. You're trying to raise capital and grow the company. So again, just like a GP we talked about is being pulled in 10 directions, so is a founder. And as a GP, identifying the founders that are capable of not only handling that stress, but multitasking in an effective manner is in my mind critical. At later stages, obviously, the companies are more mature. They have more, in some instances, more employees. They are, attempting to maybe grow their consumer base, or they have very more strategic and narrow areas of focus. And again, what value are you bringing to the table? Maybe, certain private equity firms have a stable of executives that have delivered in the past, and they can plug and play to help these companies achieve their goals. Others, again, it depends on what stage the company is in their life cycle. But, at the growth stage, understanding the numbers and understanding the balance sheet and income statement and the finances of a company become that much more critical. At the early stage, some of these companies have no revenues, certainly at the pre-seed and even potentially at the seed stage. The revenues aren't there. at the growth stage, understanding the balance sheet and the financials of a company is much more critical, because you're also valuation at the later stage becomes more critical in terms of your entry point and what you think the growth potential of the company is from the point at which you enter. So there are just different variables at different stages.
Mm-hmm.
Obviously, there are 100 variables at each stage, and we're talking
Yeah.
2 or 3 to highlight.
Sure. No, that was really helpful. And I think that's really helpful for the audience. Kind of stepping back a little broader, looking back at 2025, what are a couple nuggets of suggestions you have for GPs? Obviously, now we've got maybe a couple more weeks for anyone to get their first close or final close, and then it's going to go dark. So that's kind of what I'm thinking about. Especially, I was thinking about that when we had our allocator summit. That's what we had it before Thanksgiving, because I was just assuming that's probably the last sprint. And then any just kind of suggestions to your peers that are LPs in terms of how they're thinking through things, and wrapping up 2025, and then also kind of maybe gearing up for 2026.
Sure. I think obviously the last few years have been incredibly challenging on the fundraising side.
Mm-hmm.
We all know the statistics in terms of the amount of capital that's flowed into established managers versus emerging managers, notwithstanding the fact that emerging managers have consistently outperformed established managers
Mm-hmm.
over a considerable length of time. I think that from an LP perspective, it's important to understand that innovation never stops. I understand that DPI is limited. I understand the portfolio construction challenges that a lot of LPs are facing because there's been very little DPI, and continuing to allocate to a strategy where you may have invested, during the period of 2019 to 2022, where in hindsight, valuations were probably excessive in certain sectors, and there was a lot of FOMO where anyone raising a fund could snap their fingers and raise $50 to $75 million, despite maybe not having the strongest pedigree. And I'm generalizing, but
Mm-hmm.
there was a period of exuberance, particularly in venture. I think that's clearly over, and the capital, particularly in emerging managers, is flowing only to the most qualified teams. And even the most qualified teams are having a tremendously difficult time raising capital. We're seeing funds close at smaller raises than their targets, and that's okay. Prove yourself, execute, build a track record, and go to market with your fund too,
Mm-hmm.
maybe a little bit more soon than you otherwise would have if you had launched a $50 million fund. Maybe now you've launched a $30 or $35 million fund, but you know what? Deliver results and execute. And when the market dynamics change a little bit, it'll be that much easier to raise fund two. But if you truly have conviction that you are adding value and that you are the answer to founders within your dedicated area of expertise, stay the course. Obviously, it's expensive to do so. Mark and I have underwritten our business and haven't taken a dime out now for 2 years. But we have extreme conviction in what we're doing. We have had tremendous early success with the 2 GPs that we've backed, and we love both Puma and New Build and what they've achieved to date. And we will continue to support the emerging manager ecosystem and build our brand in the marketplace. But, it has been a challenging environment. But what I would say to LPs is this is the time to invest when, innovation is strong. And look, take AI, and AI pervades everything we do now. But maybe, when people talk about AI and valuations, maybe there are certain sectors where valuations are still high, but there are plenty of sectors and industry verticals where valuations have come back to historical norms, and there are attractive entry points. And if you can find GPs that have a defined expertise, that have a repeatable edge in these areas, now is the time to invest, because I think that these vintages, in hindsight, 5, 7, 10 years from now, will be some of the most attractive entry points we've seen in years.
No, I totally agree. Going maybe one level below in detail, I think it'd be good to actually just, talk about your firm a little more in terms of the GP seeding strategy. So there's, plenty of benefits to partnering with a firm like yours. So we'd love to kind of maybe have you share a couple highlights in terms of like GP seeding and I just see how it all connects, right? You were at some of the firms that have done it the best, and I think with GPs, to your point, they don't they can just focus on investing, and there's enough conviction in there to see that manager. They could just focus on what they do best. I mean, it goes back to, I think there was a talk with Elon Musk, and Elon Musk is like, look, I'm a product person. It's fine that I'm a CEO, but like being a CEO comes with all the chores, right? You got to get audited as a CEO. You get, staff and personnel and culture. He's just the guy that does the show, right? And showcases the Tesla bots, right? And that's what he's good at. And that's probably what he enjoys doing. So similarly, these GPs are good at finding, outlier founders that are going to provide alpha. A lot of these other things like the back office, obviously going out to market, that does take up a portion of your time, as you kicked off this conversation with. So, and then from a GP seeding standpoint, I think long term, as you're investing in those firms, getting kind of a piece of those firms, I think is a long-term revenue generator as well. So we'd love to have you maybe just talk about the strategy as a whole and kind of maybe some trends that you've seen that have evolved from like your past careers to kind of where, the exciting things that you see in the future with this strategy. And obviously this tool, the many managers I would say all managers don't know about it to take advantage of and explore.
Sure. Look, I think coming from Tiger and we, as I said, backed 5 early stage venture firms and then started our own venture studio from which we built 3 portfolio companies. We had a lot of direct investments in operating companies. The need for a large institution to go early is critical in the emerging manager ecosystem within early stage. These firms are not getting large institutional checks in many cases because no firm is going to write a $30 million check into a $40 million fund. Mm-hmm. It's just not going to happen.
Yeah.
And so the behemoth, even the large 10, $12 billion family offices that aren't writing less than a $50 or $75 million check because it doesn't move the needle for them. They mm-hmm. can't invest in this asset class effectively. And so a lot of them just overlook it. And early stage, typically, even in an endowment style portfolio, isn't going to be more than 10% of a true endowment style portfolio. And so again, it's an area that's overlooked oftentimes by large institutions. We sought to build a firm at scale that could accommodate large institutional checks, but do so in a diversified, de-risked way, to your point, through our partnership with our GPs. And I think it's important. The most important thing to us is, yes, we are a huge check to these emerging managers that is critical to them as they're launching their business because they can start warehousing deals, and it's helpful to them in marketing to say 40% of our fund is committed, and all of that has value. But if we were just a check, we wouldn't be doing our jobs mm-hmm. because 5 to 7 years down the road, I don't ever want a GP to say, yes, you wrote me a check 5 years ago, but what have you done for me lately and why am I still giving you a portion of my revenues? We have to earn our GP's trust and respect every single day. And I'll give you a couple of anecdotes of things we've done to date and the type of partner we want to do. We will not meddle on the investment side. We don't micromanage. We don't tell our GPs what to invest in. They're the ones investing capital. They're the experts. We're choosing them because we believe in them to source deals and invest capital. Where we want to help them is everywhere else. And 2 anecdotes. So one of our 2 GPs had a large corporate pension investor that was looking to commit about $5 to $7 million. And they served up a 10-page side letter. This GP was going to go to their counsel, and they have an excellent legal counsel where the partners are charging $2,400 an hour. And they were going to go to that counsel and say, negotiate this side letter for us. We really haven't done much of this. Mark and I have negotiated hundreds, if not thousands, of side letters in
Sure.
our 60 plus years in the business, collectively. Marcia as well. Marcia is the third member of our team. New York Ventures and FFVC prior to that. We said, give us a shot at it. If you don't like what we do, you can still go to your counsel, whatever. We marked up the side letter. We got them to a great place. They brought it to the investor. The investor committed, accepted all the changes, probably saved them $25,000 or $30,000 in legal bills. That to us is real value add because it goes to their bottom line. Another instance, there was a prospective LP, and it was about June 5th of this year. This particular GP was having their second closing on June 30th, and the LP had completed their IDD. They outsourced their ODD, and their outsourced ODD professional was in Europe for 2 weeks and said, I'm not back till the 19th or 20th of June, and I'll never be able to complete it by June 30th. So the GP came to us and said, would you be willing? We have a 30-page ODD report that prior to us committing, we do IDD, ODD, legal due diligence, background checks, credit checks, reference checks, a full institutional due diligence process before we go to investment committee. So we signed an NDA with the prospective client. We gave them access to our ODD report. They signed an NDA that had a non-reliance and everything else, so we were protected. They took our ODD, leveraged that with their ODD, and brought it to their investment committee, and they made it in time for the June 30th closing. Again, real value add to that GP. And these are the things that this GP will remember and will know that anytime they need us, we're going to be there for them in an instant. And that's the type of partnership we strive to have with the GPs we back every day.
Yeah, because it's still competitive to kind of find those great GPs. A lot of the top ones get oversubscribed, but you get recommended by your GPs that you support. They go and sing your praises, and that's how you kind of get connected to a lot of these other great managers. On the flip side, what should managers have buttoned up as they approach you? I guess on their story, on their deck, on their portfolio construction. What are kind of some of your typical guideposts in terms of kind of making it through the first Monday partners meeting, right? I'm assuming you guys have kind of a pipeline of managers that you're talking to. So what are the first couple of things that stand out that say, hey, you know what, let's actually, take a second look. Let's actually take a look at the data room and look at some of these, look at some of their warehouse deals. So what's kind of the toolkit that managers need to have together, especially when they're thinking about like a seeding type of LP?
Yeah, I think first and foremost, be prepared, know your audience. And, we've met with 450 plus GPs in the last year or so. You'd be amazed at how many of them have come to us before they even have a firm fund strategy, before they have fully baked ideas on how they intend to build their firm, their brand, or even their fund. And what I would say to a prospective GP is take the time to develop a proper business plan at both the fund and the firm level before you engage in a conversation with a potential anchor or strategic investor, because you only get it. I mean, the old cliche, right? You only get one chance to make a first impression. And if you're coming to us and saying, well, and we're asking questions about your strategy or your firm or how you're thinking about building either one of those things, and you can't answer it and say, oh, we really haven't thought about that yet. We're still iterating on that. We haven't gotten there yet. Like, how is that helpful to us? If we're planning on committing, $20, $25 million or more to you.
Well, you're going to have to answer you're going to have stakeholders too. And it's going to bubble up to you as well at your level as well. Right. So.
Yeah. But you'd be amazed at how many GPs come in unprepared, just looking for guidance but it's a pitch, but they don't have anything fully baked. And maybe we'll revisit them 6 months down the road once they've got their what together. But chances are we're only going to back 12 GP teams, give or take, out of our first fund. We're going to meet with probably 1,000, so you really have to shine and excel in that first 30 to 60 minutes in order to get a second look. On average, we're advancing about 15 to 20% at most of the GPs that we meet initially to even a second meeting.
Sure.
And to your point, then probably 15 to 20% of that 20% to where we're going to go into the data room. We're going to really take a look at past deals, present portfolio companies, what have you, and really, spend a considerable amount of time and resources. And then we've got, to your point, we've got our funnel. So we've got our top 10, and that's iterative. It changes, to your point, every week. We meet every Monday morning and reset both our top 10 as well as each of the other categories. Folks, we want to move to the second meeting. Folks, we want to move past that second meeting to a deeper level of due diligence. But there has to be a KPI, a milestone at each stage of those where we see the potential that you could tick all of the boxes. It's not to say that you have all the answers or have everything figured out at that stage, but over the course of the 4, 6, 12 months that we're going to do due diligence, get to know you both as investors and human beings. Because if we're going to form a partnership with someone, it's not just about their pedigree and their investing acumen. We want people with integrity, people with empathy, people who are going to be good stewards of capital, fiduciaries to their investors and to us, people who are effective communicators, people who we feel that are going to be responsive to their investors. Those are the types of people we want to partner with. And so understanding that complete picture of the type of human beings you're investing with, in addition to the type of investor you're investing with, those are all critical parts of our process.
Yeah, no, that's helpful. Well, I know we've got a couple minutes left. 2 more quick questions. So one quick question I have is, I've had a handful of our alumni fund managers, start thinking about fund 2, and they're coming into bigger AUM. They need to actually have more staff to deploy that capital effectively. So part of that has been to kind of build a culture around the team and obviously develop their own leadership. Many of these people have worked as corporate executives for several years, and they've learned that in their past roles, as we normally do by default. But when it comes to leadership and investment management and building culture, maybe based on some of the managers that you've seen, and obviously as you're growing and scaling your own firm, what's some advice you'd have for people to kind of do that? And that also relates to attracting talent and retaining them as well, because the culture is so important. If you got a toxic environment, those people aren't going to last that long. So.
Yeah, and that's part of what I just alluded to, is understanding the type of human beings you're investing with, because those are the human beings, to your point, and it's an excellent point, that are going to be building a firm culture. And so how do they think? Those are conversations that we have early. How do you think about building a team? What are the most important milestones that you're looking for when you evaluate the growth of an employee? What do they have to do to advance from principal to partner, or what have you, from analyst to principal or associate to principal, whatever, however they're defining the different roles that they're hiring for. But most importantly, people that are self-aware and that understand they may be good at a lot of things, but they're not good at everything. And there's always someone smarter than you. And surrounding yourself, and I alluded to this earlier, surrounding yourself with people with complementary skill sets, where 1 + 1 = 3, not 2. Surround yourself with people that bring in skills that maybe you have them, but if you're a great investor, maybe bring in someone with someone on the finance side that can really help you in terms of digging into company valuations and things of that nature, or that can help you as you build out your own firm in terms of your expense structure and things of that nature on your own side. and how you can spend efficiently to maximize resources as you grow and scale. Maybe it's someone on platform that will help your companies think about different areas of their business that aren't front and center in your mind. It can be any number of skills, but how do you think about growing your business most efficiently with resources that will be additive, but also redundant?
Mhm.
Having redundancies, and you alluded to this, is critical too, because number one, we've all seen through the banking crisis and otherwise, maybe having, and as cyber fraud and other things continue to be prevalent in our industry, having two sign-offs on cash movements and having just basic protections in place when you're running an institutional quality business, that's what investors want to see. And so having the necessary safeguards and resources in place at your own firm level
Mhm.
to be able to scale efficiently and to do so proactively rather than reactively is also critical.
Sure. Yeah, that was really helpful. And then we got one more for you, Scott. So just one final piece of timeless advice. It could be from a mentor, it could be from a relative, it could be from one of your managers, but any piece of wisdom you want to leave us as we enter the holidays and kind of look back at 2025.
Yeah, my grandfather and my father both used to say, it doesn't cost you anything to be nice to people.
Mhm.
And that always stuck with me. There are a lot of people that choose not to, but you gain, and I mean, it goes back to the old saying, you get more with honey than vinegar. And look, there's a time to be firm and strict, but I find that people respond better and you build more meaningful relationships. Again, it goes back to perspective taking. Understand where the other individual is coming from. So where you can, and especially early on in a relationship, when you're building trust, as you earn trust and get to know someone more deeply, maybe you can have more candid and frank conversations in a way that won't offend, and maybe you can get a little deeper in a more meaningful way. But be nice.
Yeah.
Earn people's trust and earn people's respect. Don't just expect. And don't expect things to be handed to you and given to you. Earn it and go out every day and embrace the opportunity rather than expecting things to just be handed to you.
Sure. Well, hey, Scott, this was amazing. Really appreciate you making the time for me. And, just want to reemphasize just all the impact that you're creating and all the people that you support. So thank you. Thank you. And
Thank you.
hope we have a good holiday. We'll catch up soon. And thanks for
Likewise, I
everybody else.
appreciate it. Thank you
All
so
right.
much.
Thank you. Bye.